The world is chaotic. The future is never clear.
Historically, that's the time to get out.
The U.S. stock valuations, for example, are on the high side.
This is an oscillating chemical reaction. Combining certain reactants under the right conditions results in unpredictable swings between colours. And while it has nothing to do with the economy or the stock market, it's a mesmerising analogy for how small changes in a dynamic system can produce unexpected circumstances. This is the kind of environment we face in 2025, according to some of the most respected people in the world of finance. So what exactly is a stock market bubble? Are we in one right now? And how should you be investing differently than what's worked before?
That brings us to 2025. What lies ahead?
I probably titled this video something ridiculous or obnoxious, and I do apologize about that, but I felt like since I've been away from YouTube for so long, I needed to get back into the YouTube algorithm. To quote one of my favorite movies,
"Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles.
We can't predict exactly when a stock market crash might occur, but we can look at the state of financial markets to get a better idea of where we might be in the cycle, which is where I turn to Howard Marks. His understanding of the rise and fall of stocks across history is unrivaled, and in January of 2000, he published a memo called Bubble.com, outlining his concerns that internet stocks and the broader US stock market were primed for a cataclysmic crash. And just a few months later, it began. 3 straight years of negative stock market returns, and a cumulative return of just 9% for the 11-year period of 2000 to 2011. This week, exactly 25 years after he posted that memo, he published this, his observations of the similarities in today's artificial intelligence-fueled market to that of previous bubbles. But let's first start at the beginning. What is a bubble?
A bubble or crash is more a state of mind than a quantitative calculation.
People always point to the recent surging of stock prices to say that we're in a bubble. And while it's true a crash is usually preceded by strong stock returns, there are some other important characteristics.
Highly irrational exuberance, outright adoration of the subject companies or assets, and a belief that they can't miss. Massive fear of being left behind if one fails to participate, and resulting conviction that for these stocks, there's no price too high.
When these qualities exist in markets, people begin to believe a very dangerous notion, that there's no price too high. According to Marks, while there are of course valuation ratios and calculations that help gauge how expensive the stock market is, it's a psychological diagnosis that proves more effective. From a simplistic perspective, there are 3 stages of a rising stock market. Stage 1 comes right after a crash. Investors are pessimistic about stocks and expect the pain to continue far into the future. Stage 2 is where companies and the economy more broadly begin to show signs of improvement. And then in stage 3, the economy is booming and companies are performing well above expectations. Stocks rise fast because investor expectations swing from pessimistic to optimistic. And it's here that everyone starts believing that company earnings will never stop growing.
The important inferences aren't with regard to economic or corporate events. They involve investor psychology. It's not a matter of what's happening in the macro world. It's how people view the developments.
But stock market bubbles are a very specific type of bull market. They're the very rare circumstances where irrationality gets taken to the extreme. What causes them could be summarized by one of the oldest phrases in the world of finance. This time is different.
Bubbles are invariably associated with new developments.
A new technology that's rapidly changing the world, or it could be a new investment product that unlocks wild speculation on what was previously considered a safe asset. When something new comes along, there's no historical context that you can use to easily determine that prices are getting too expensive. Take the endless number of internet companies that popped up in the late 90s.
In the TMT bubble, the companies didn't have earnings, so PE ratios were out. And as startups, they often didn't have revenues to value.
Investors could sense that the internet would change the world, and that some companies would make billions of dollars from it. And that sense was correct. Look at some of the biggest companies in the world today. They were born out of the internet. But it's that little kernel of truth which fuels the bubble.
As a result, new metrics were invented, and trusting investors ended up paying a multiple of clicks or eyeballs, regardless of whether these measurables could be turned into revenues and profits.
Eventually, these metrics did become advertising revenue, at least for some of the companies. But at the time, guessing how much each website view or click would convert into advertising revenue was basically impossible, and it led to many companies, many stocks being massively overvalued. Howard Marks then shares another bubble he lived through in the 60s, which he says gave him a deeper insight into how these things come about.
I joined the equity research department at First National City Bank, now Citi, in September 1969.
Their primary focus was a group of stocks known as the Nifty 50.
Stocks of the best and fastest growing companies in America.
These companies were considered to be so good that A, nothing bad could ever happen, and B, there was no price too high for their stocks.
After World War II ended, the US economy went through a boom time, where lots of innovations were made in a number of industries, including computers, pharmaceuticals, and consumer products. And like every previous bubble, investors became over-optimistic about the profits these businesses could produce.
The Nifty 50 were the object of the first big bubble in roughly 40 years.
In many cases, their price-to-earnings ratios fell from the range of 60 to 90 to the range of 6 to 9.
That means that from 1969, these stocks fell by 90% over a 5-year period. There are some invaluable lessons in this period for the stock market.
It's not what you buy, it's what you pay that counts. Good investing doesn't come from buying good things, but from buying things well. There's no asset so good that it can't become overpriced and thus dangerous. And there are few assets so bad that they can't get cheap enough to be a bargain.
But the Nifty 50 bubble of the late 60s should also draw your attention to the most beloved stocks in today's market, the Magnificent Seven. Microsoft, Amazon, Apple, Alphabet, Nvidia, Meta, and Tesla. These companies are growing fast, and many investors believe they can do no wrong. But most importantly, they're all expected to be the biggest beneficiaries of a new technological development, artificial intelligence. So the question is, are they in a bubble? The first note is that they're certainly not as expensive as the Nifty 50 stocks were before their 90% collapse.
The further good news is that today's leaders don't trade at the PE ratios investors applied to the Nifty 50. Perhaps the sexiest of the seven is Nvidia, the leading designer of chips for artificial intelligence. Its current multiple of future earnings is in the low 30s.
But it still might be high. Consider what a price-to-earnings ratio actually tells us.
If there's a company for sale that will make $1 million next year and then shut down, how much would you pay for it? The right answer is a little less than $1 million, so that you'll have a positive return on your money.
The reason we're willing to pay a price for a stock that's many multiples of their next year's or last year's earnings is because we expect that company to be producing earnings and operating for many years into the future. Paying 30 times earnings for Nvidia means you're expecting the company to survive for decades, and that through those years they'll continue to dominate, growing their profits year by year.
In other words, investors are assuming Nvidia will demonstrate persistence. But persistence isn't easily achieved, especially in high-tech fields where new technologies can arise and new competitors can leapfrog incumbents.
25 years ago, these were the top 20 companies in the S&P 500. Only 6 of them are still in the top 20 today. So some of today's biggest companies will be the biggest companies in a couple of decades' time, but most of them won't. But it's not just the AI tech companies that have been surging in price recently. The entire market has been hot, rising about 26% in 2023 and then another 25% in 2024, the best 2-year stretch since the internet bubble.
Prior to 2 years ago, there were only 4 times in the history of the S&P 500 when it returned 20% or more for 2 years in a row.
In 3 of those 4 instances, a small sample mind you, the index declined in the subsequent 2-year period.
The outlier again, the internet bubble. The market had exceptionally strong years between 1995 and 1998.
when the powerful TMT bubble caused the decline to be delayed until 2000.
But then the index lost almost 40% in 3 years.
There are times where an industry-specific bubble will spread to the entire stock market, and this happens due to a combination of tailwinds. In the 90s, it was the internet companies' tech bubble in combination with declining inflation and interest rates. An exciting technological revolution in combination with a shift in broader investor optimism. You might say that we're in a similar set of circumstances today. In the last couple of years, we've seen inflation come down significantly, and more recently, interest rates as well. And the market has bounced back in full force after its 2022 crash.
Lately, I've been repeating a quote I attribute to Warren Buffett. When investors forget that corporate profits grow about 7% per year, they tend to get into trouble.
Corporate profits have been growing a lot, but stock prices have been growing faster, which means stocks have been getting more expensive, and that cannot go on forever. But by far the most interesting part of the entire memo is this chart from JP Morgan. It plots the forward price to earnings ratio of the S&P 500 against the subsequent 10-year market return. Or in simpler terms, it's looking at how the expensiveness of the market impacts future returns for investors. And there is a very strong correlation. The more expensive the market is, the lower returns investors made for the next decade.
In that 27-year period, when people bought the S&P at price-to-earnings ratios in line with today's multiple of 22, they always earned 10-year returns between plus 2% and minus 2%.
The implication being that if history is anything to go on, we should have pretty limited expectations for stock market returns over the next decade. But it's not just that stock returns could be weak.
You might say making plus or minus 2% wouldn't be the worst thing in the world.
And that's certainly true if stocks were to sit still for the next 10 years as the company's earnings rose, bringing the multiples back to earth. But another possibility is that the multiple correction is compressed into a year or two, implying a big decline in stock prices, such as we saw in 1973 to 74 and 2000 to 02. The result in that case wouldn't be benign.
That's not a very cheerful thought, but I do want to emphasize that none of this is a reason to stay out of the stock market. Even if stock returns are relatively weak in the coming years, we have no idea how it might look. There's nothing that says there has to be a stock market crash. We could just see weak returns year by year, and therefore if you stay out of the market, you just miss out. And there's also some pretty important counter-arguments to consider.
The PE ratio on the S&P 500 is high, but not insane.
The Magnificent Seven are incredible companies, so their high PE ratios could be warranted.
I don't hear people saying there's no price too high, and the markets, while high-priced and perhaps frothy, don't seem nutty to me.
The reason I never ever make investment decisions based on these broad bubble predictions is because that implies that you can even tell how expensive the stock market is. Sure, it's definitely on the high side compared to past periods, but in order to truly know if it's expensive, you'd have to know the profits of all corporations over the next decade. And that is just as much of an impossible task as the investors trying to predict the profits of pre-revenue internet companies. So the rational choices are either to pick individual stocks where you have a deep knowledge of the specific business, or buy an index fund, stay the course, and accept whatever return the market provides. I'm back to weekly videos now, so subscribe if you haven't already, and check out one of these videos next.